Welcome to First Thursday. Thank you, everyone, for taking your time today. And I just really want to be able to give everyone here answers to some questions. So we're going to go over what asset protection is. If you're considering growing your practice with asset protection, that's really the first step. It's really getting a very strong handle on what asset protection means today. It's not necessarily obvious, and it's gotten a little more confusing over the years in some respects, not less confusing, because more options have come up and a lot more people have kind of gone out into the world and said, okay, I do this and here's a way to do it. I feel like we have a very good messaging on how to explain asset protection, and that's part of what we our offer is a really clear understanding of what asset protection options are available. So as we go through this, I really want you to listen to it as you were the client or the prospective client, because I explain it to clients the same way I'm going to explain it today. It's really the same messaging, and the order in which we present it, the way in which I present it, it all has a purpose and a place and a meaning. So, the fact that I talk about the offshore option first and then the domestic option, that's on purpose. It's not random at all. We've spent 20 years developing our communication style so that we very clearly get the message across and help the client understand what their options are. Our philosophy is that a client who is making a decision and a choice is a much better client than one who's kind of being sold into a strategy or feels like they don't have a good handle on things and they're just trusting the attorneys. That's not a good client for me. I want clients who understand what they're doing, that are educated enough to make good, competent decisions, ask me good questions. Those just make better clients. And you're going to see when it comes to asset protection, that's really, really important. I mean, you really have to have clients that are on board, because this is complicated enough that if you don't, then clients can easily get confused. And a confused client is the last thing you want. And it's one thing to have a confused client where they really have no other choices. It's another to have a confused client in something where it's really an optional, voluntary thing that they're doing. You need them on board, I believe. So watch it this way. If you already do asset protection and you're looking at this and just saying, you want to see what's going on in the field, then I would really ask you to pay attention to the direction that we take this with respect to the bridge trust and how powerful a tool that is and how it contrasts with both the foreign asset protection trust and the domestic asset protection trust. I can tell you it is a very, very powerful concept. And even if you're already doing foreign trust or domestic trust, I would make the very strong case that the bridge trust is a much better option for you and your clients. You'll sell more of them, and they are more effective. They're just the best tool that I've seen. So watch for that as we talk about this. Also, I really encourage everyone to ask questions. There's a question box there. Type them in. I usually wait till the end and I'll get to all of them. So please don't hesitate to ask your questions. If I say something that doesn't make sense to you, ask me a question, because that's how this works. You above all need to understand how this works. So my goal for this webinar is to give you a very good idea of the way I present asset protection to clients. And this is, for me, the best way to grow your practice. It's a great field. It's something that people want. With the recent change of the unified credit, I mean, $11 million per person, $22 million per couple. The vast majority of the average estate planning clients do not need any sophisticated estate planning at all anymore. I mean, they're not going to have any federal estate taxes. So, what are they going to do? I can tell you that a client with just as little as $1 million or less, certainly clients with $2 or $3 million, absolutely are the prime candidates for asset protection. I can't pound this concept in hard enough. A client with $1 million or $2 million of total assets, total net worth, is an ideal asset protection client. That is my average asset protection client. And when I started this, it was well under $1 million. Now it's probably around 2 million is the average net worth of a new client that walks in my door. Attorneys are usually shocked at this. They can't believe that someone would spend $26,000 to set up an asset protection structure to protect $2 million. Well, if that's your $2 million and you've worked 30 or 40 years to put it in the bank and you're looking at retiring in the next 10, $26,000 to protect that is a drop in the bucket. And believe me, they are absolutely willing, able to spend that money on it. So again, pay attention to your preconceived ideas about what this is. I would ask you to just kind of set them aside. Put yourself in the position of a client with a couple of $1 million of total net worth that is somehow afraid. They've gotten a little a scare from something, and that's when they're usually reaching out to us or to you, and they're saying, "Hey, I'm feeling a little nervous." That's the person that we're really talking to here. So let's jump into it. My name is Douglas Lodmell. I'm the co-founder and managing partner of Lodmell & Lodmell, and we've been doing nothing but asset protection since 1997. My partner is my father, Gary Lodmell. He was really on the forefront of this way back in the 80s and really jumped in and was one of the original, really founding attorneys that focused and built a significant practice around asset protection. So we are also the creators of the Asset Protection Council. This is the network of attorneys that we affiliate with, that we co-counsel with to help them add asset protection to their practice. And that's what I'm offering to you here, is to be a co-counsel with you. So I definitely do not suggest you run out and try to do asset protection alone. I do suggest you run out and try to do it, but you should do it with an experienced counsel by your side with a great strategy, with a proven track record, so that you can deliver the highest level of services to your clients. Okay, so why would you want to do asset protection? One, it attracts better clients than estate planning alone. I mean, it's a higher level client. It's a client that's thinking differently than estate planning client. As we already mentioned, the estate planning unified credit exemption has gone up to the point where most people are just not going to think about it. It's hard enough to get someone to think about doing their estate planning now that there's really no compelling tax reason. It's really going to be hard. When you do asset protection, it leads to a more complete estate and business plan, and frankly, more work. I mean, I have a lot of the best affiliate attorneys I have are the ones that use asset protection as a lead-in, because it's the sexier of all of the things that we can offer clients. But then they end up really focusing on how do we get our all their other work, their business planning work, their corporate work, their estate planning work. So it's just a great lead in for that. Asset protection has a higher price point than estate planning alone. Our average plan runs $20,000 to $30,000, and that's about 10 times what an average estate plan is for many of the estate planning attorneys out there. So it's really a great revenue source for your practice. And trust me, clients need this and want it. They are searching. Have your web person do a search for asset protection on the internet and tell you how many searches there are in your area. I'm going to tell you that it's significant. A lot of people want asset protection. So if you can be the competent source of that information, you are going to be who they call. So clients what do they want? When it comes to asset protection, they want effectiveness. It better be effective. The last thing you want to tell a client is that, this is a good 50-50 chance it's going to work. No, they want to hear that they've got a 99% effectiveness. They want control of their assets. We know this. Many of them want control beyond their grave, but certainly they want control while they're alive. They want the costs to be reasonable. And again, I mentioned what our fees are. If you're used to quoting clients $2,000 or $3,000 or $4,000 for a revocable living trust, it may seem like, wow, how do I quote them $25,000 or $30,000 for an asset protection plan? But trust me, in the context of the way that we talk about it with clients, I virtually never get pushback on the fee. It's reasonable in the context of what we do, and in the context of the assets that we're protecting. Compliance. They don't want They don't want to have to be told that this is going to cause 5 extra tax returns and special reporting requirements and all that stuff. And you'll see why I put this up there, because one of the options has a lot of compliance and one doesn't. Okay, in the world of asset protection, there's lots and lots of tools. I mean, lots of tools. I'm going to just talk about three of them. I'm going to talk about the limited liability company. I'm going to talk about the limited partnership, what I call an asset management limited partnership, and I'm going to talk about the asset protection trust. And that's going to be the focus because that's really the key when it comes to asset protection. But the other two are important because they go with the asset protection trust. And because of that, I think it's very relevant to keep them front and center. So the limited liability company, as we all know, is great for protecting risky assets. It's great for wrapping things up, kind of putting them in a Ziploc bag. We can segregate assets into separate LLCs. So for clients that own multiple properties, investment properties, we'll use multiple LLCs. LLCs work as asset protection vehicles because they have charging order protections. Some states better than others, but the general rule is that if you get a judgment against a member of an LLC, you can't reach the LLC assets. You can only put a charge against that member's interest. That has proven by and large to be pretty effective. And because of that, these tools in and of themselves are already a good asset protection strategy. What about the asset management limited partnership? Well, a limited partnership, like an LLC, has charging order protection. In our case, we use it as a holding company. We all are familiar with family limited partnerships. I call mine asset management because I think it's a more accurate term, and I also want to distinguish it from family limited partnerships. Family limited partnerships are a little bit confusing out there. People, they have good reputation, and then they have a confusing reputation when it comes to the disallowance of some, deductions for minority shares and so forth. I think it's clearer and easier, and I certainly have branded asset management limited partnership, and it's better for clients to understand what that partnership does. I explain it to them as a holding company, their holding company. What's it going to hold? It's going to hold the LLCs that have the other interests, like the investment real estate, the operating businesses, other companies, etc. It can also hold cash and accounts and investment accounts directly. So in some cases, we might have an LLC that does the investing, which is owned by the partnership, or we might have the partnership directly holding the investment account. It also has charging order protection. And I almost always use Arizona for the limited partnership. There's a technical legal reason for that, which is related to how it connects to the asset protection trust. In Arizona, there's a statute that allows for a limited partner to unilaterally withdraw from the partnership, which is not normal. Normally, limited partners don't have any right to withdraw from a partnership. But in Arizona, you can, as long as it's predefined in the document. So in other words, you have to define a pre-existing condition upon which the limited partner could withdraw. That is a beautiful connection to the asset protection trust, which thrives on defining conditions upon which certain things would happen. So that's the technical reason we use Arizona. The other reason is that Arizona has been very good about making the charging order the exclusive remedy for the partnership. So in California, for example, it's not. The judge has discretion. In Arizona, it is the exclusive remedy against a partner, and that's good. And Arizona's been good about sticking with that, not breaking their own rules. So we really like Arizona. Not to mention that my firm is in Arizona, and we can serve as the statutory agent for the client, again, making it more simple. Arizona also is one of the very few states that does not require an annual fee or an annual report to be filed for the partnership. Well, that's just one less piece of paper that we have to do for our clients, or that our clients have to do for themselves. One less chance that they have something to mess up. So for all those reasons, I'm a big fan of Arizona limited partnerships. And it can include the family members, and it can, of course, can include the asset protection trust. So that's the whole concept. We can also add privacy to the family limited partnership by using a general partner that is a Wyoming LLC. In Arizona, only the general partner needs to be listed when it's registered. So if we want privacy around the assets, which some clients do value and need and want, then we make the Wyoming Limited Liability Company the general partner, and that creates a completely private structure. It's very effective, and of course, an LLC as a general partner is a good structure to have, especially if you're are going to put any kind of risky assets in the partnership. Okay, let's move to the asset protection trust. This is kind of the big daddy. This is the big thing when it comes to asset protection. I think you all know everything I've already talked about, but some of this might be new. An asset protection trust is an irrevocable discretionary trust. That's what it is. It is designed to protect the assets because it also has spendthrift provisions. This trust radically enhances the other two structures we talked about. So in the olden days, I would say in the 80s, doing a limited partnership in an LLC, that was kind of the extent. If you did do an irrevocable trust, it had to be an old style one where the kids were, it was a completed gift to the kids. And most clients would do that, but only for a small portion of their assets, not for all their assets. The asset protection trust is capable of protecting all their assets. So it's extremely effective in increasing the protection of the partnership LLC structure. Asset protection in general is not limited to a specific risk. I threw this in here because clients always ask, well, what about insurance? I have great insurance. And the answer is, well, insurance is good as long as the issue that arises is covered. In other words, insurance covers liability. Asset protection covers assets. So we're not limited to a specific risk. We are focusing on the assets themselves. So my answer to clients is that don't cancel your insurance. I'm a fan of it, but it does not cover everything. It will not cover everything, and you definitely need to be enhancing it if you really want true protection. And then, of course, as we just discussed, we can create privacy over your entire structure. For some people, this is very, very important. For others, it's not very important at all. And of course, protection for your assets. So let's talk about the asset protection trust itself, because this is the part that most people listening are going to be less familiar with than the others. What is an asset protection trust? Well, it's an SSST. And an SSST is a self-settled spendthrift trust. So we're all familiar with self-settled trust. Every revocable living trust out there is a self-settled trust. And we're all familiar with spendthrift trusts. Every trust that you set up for a grandchild or a child, almost all have spendthrift provisions in them, which say basically, hey, if my child has a creditor, the creditor doesn't have access to this money. If my child gets divorced, the ex-spouse would not have access to the assets of the trust. Those are spendthrift provisions. Well, with an asset protection trust, we combine what before the 80s was uncombinable, which is a self-settled spendthrift trust. So how did this happen? Well, there's two schools of thought when it comes to asset protection. There's the international world, and then there's the domestic. So how this happened is that the international world passed a statute. In fact, it was the Cook Islands, and you're looking at the Cook Islands flag there. And in 1984, Cook Islands passed the Cook Island Trust Act, which said it is totally cool if you want to set up a self-settled spendthrift trust in which you are the beneficiary of the trust, and yet you create very strong, robust spendthrift provisions around the assets of the trust. Those provisions will absolutely ironclad protect the assets only for your benefit, and if a creditor tries to step in there, they're not going to get it. How do we enforce that? Well, we statutorily are not able to recognize any other jurisdiction's court orders or judicial proceedings. Cook Islands said that's the way. We tied our own hands. We made ourselves unable to recognize any other country's courts. We are only allowed to recognize a Cook Island court. That's all we're allowed to recognize. So great. And what happens in the Cook Islands? Well, first of all, if you do want to pursue a trust and with a claim, you'd have to start your case down here because we don't recognize any other jurisdiction. If you want to start a case down here, you have to be prepared to prove your case beyond a reasonable doubt. Well, I think we all understand that burden of proof. It is exceedingly high, beyond a reasonable doubt. It's the criminal, it's the murder standard, it's the OJ standard. It is extremely hard to meet. And so, whereas with a civil case, it's just preponderance of the evidence, which is 51%. Beyond a reasonable doubt is 99% in my mind. That's the way I kind of frame it. Um, and for a civil case, that's an unreasonable burden. But hey, if you're setting up a statute to protect assets, that's what you'd want to do. We're also not going to allow any contingent fees down here because we don't want a bunch of contingent fee attorneys taking cracks at our case, at our trust. So you better write a big check to an attorney that's willing to take a case. Pretty sure he's going to lose it because he's not going to be able to prove it beyond a reasonable doubt. And that also assumes that they even got the case filed in a timely manner, with the statute of limitations being very short in the Cook Islands, 1 year or 2 years, depending on the case. And once you do file a case, you can't amend it. So there's no fishing expeditions in the Cook Islands, none at all. If you find something new, you have to start a new case. Again, assuming your statute of limitations hasn't run, which probably it has. Also, when you lose the case, the loser pays. Well, are you going to lose? Probably, with all these hurdles in front of you. So you're going to have to put up some money to make sure that you can cover the legal fees of the winner. So bottom line is that Cook Islands has proven over the past 30 plus years to be a very, 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 very difficult jurisdiction for anyone to break a trust in. And that is the good news. It is unbelievably effective. So on our 4 criterion of what clients want, Cook Islands on effectiveness absolutely wins. I'm using the Cook Islands as an example because it's the first jurisdiction. I consider it still the best jurisdiction. There are other jurisdictions, Nevis, Belize, Bermuda. There are about 24 different jurisdictions. They all have very similar statutes, but we can't go over all of them, and I don't think there's really any need. Understanding the Cook Islands is really enough to understand that if you are serious and you have a client that absolutely wants to create a nest egg trust, take some money, put it into a Cook Islands trust, open an account in Switzerland, have it managed by a money manager, there's nothing more protective in the world. It is effective. Okay, what are the cons to it? Well, clients are not necessarily very comfortable just going straight offshore. Cook Islands is far away. Most people have never heard of it. It's a small little island. So, what happens if the trustee runs off with my money? Which there's very clear checks and balances that we explain to clients how that actually is incredibly difficult for a trustee to do because they don't have direct control. But nevertheless, it really does make clients less comfortable. Add to that if you tell a client, well, it's a foreign trust, and foreign trusts are required to file Form 3520 and 3520A. There's the FBAR, and if there's foreign accounts, which probably there needs to be if there's a foreign trust involved, then we have FACTA disclosures. Most clients now are starting to go, okay, wow, I was really liking it before I heard about all this. Also, the fees and costs. It's a foreign trust. You are dealing in a jurisdiction where that you pay for the privilege. So fees and costs are going to be higher than any other trust I know of. I mean, we're talking significant. So again, if you've got a client that wants to take $5 million, nest egg it, completely wrap it up and just say, hey, I'm going to forget about this money and set it up for my children and grandchildren, and I want it untouchable, this would be a great choice. But for your average client with the $2 million that we talked about in the beginning, this starts to seem like an expensive and burdensome choice. So they start to think twice. So control. They have to give up control to the foreign trustee in order for this to work. So that is something that most of those $2 million, $3 million clients are going to be very hesitant to do. Compliance, we just talked about it. It's significant. Accountants, when we do have to do a foreign trust, they're usually like scratching their head. They're not familiar with this. They want to know how it works, and they usually charge, not a nominal fee to get the forms filed, and it's annual. And the cost. I tell clients to budget between $5,000 and $10,000 a year to maintain their trust. And you can expect setup costs of $30,000 plus to set up a foreign trust. Domestic. Okay, let's go to the other side of the coin. 1984, the Cook Islands passed the statute. I will tell you, between 84 and 94, a lot of my colleagues were saying, "Hey, um, this seems like it should be totally illegal, against public policy." I mean, I think that you're really kind of a scoundrel even setting up a foreign trust in the Cook Islands. So there was some question whether this concept would be accepted in the United States. That was all answered in 1997, because what happened is that Alaska passed a statute with a domestic asset protection trust, which was a self-settled spendthrift asset protection trust. And now we have 17 U.S. states that have all passed legislation, and it seems like every year there's one or two more that come online. So the concept of asset protection has clearly been accepted by at least a third of the states. We have dictum in federal cases which state that asset protection is a valid purpose for people to do things, and we certainly have federal statutes and asset protection in place. So ERISA plans are asset protected, homestead exemption at the state level, homes are protected. So the concept of protecting assets is certainly acceptable. This is a good thing. So for me, the domestic asset protection world kind of coming online has been a really good thing, because it has validated the concept of a client taking specific steps to protect their assets is okay to do. And again, in the very beginning of this industry, that was a question mark. But today, it's not a question mark. I think everybody acknowledges, everybody I know, nobody says to me anymore, "Wow, this seems a little sketchy." They understand that this is actually not sketchy at all. It's completely valid, and it's understandable by why a client would want to set up a structure that is designed to protect assets. And again, as with the foreign asset protection trust, the domestic trusts are often paired with LLCs or limited partnerships to provide that first layer of charging order protection. So the structure of the two are virtually identical in the way that they set them up. The difference is the jurisdiction. So let's talk about that. What are the pros? What's the good side of a domestic asset protection trust? Well, there's no offshore component. So you have a lot easier time with clients accepting it. So if you say, "Hey, we're going to set you up a Nevada trust," clients are like, "Oh, okay, I'm familiar with Nevada. I know they do corporations there." Or if you tell them it's a Delaware trust, "Oh, okay, that makes sense to me." They feel comfortable. It's a lot easier to get them to accept that. Because it's not a foreign trust, you don't have any of the foreign trust tax compliance issues. There's no foreign accounts that need to get set up. There's no foreign trust, so there's no Form 3520 or 3520A. It's really pretty simple. You 1041 trust tax return, and that's really it. And it may be less expensive. I say may because prices for domestic trusts are all over the board. It has become something that a lot of attorneys said, "Oh, okay, now that I have documents from my document preparation software or from the trust company that just had a booth at my state bar convention, I feel comfortable I can do these trusts." And so I've seen domestic asset protection trusts for as little as $3,000, and I've seen them for $20,000. So they really are all over the board. So what's in our checklist of our 4 things? What are the good things of the domestic asset protection trust? Compliance, there's not really any, none of the foreign stuff. Cost, maybe it's lower. I would say in general it is lower. I would say the average cost of a domestic trust is probably around $10,000. So again, much less than a foreign trust. What about the cons? Okay, this is really the issue with domestic. Article 4, Section 1 of the U.S. Constitution states that full faith and credit shall be given in each state to the public acts, records, and judicial proceedings of every other state. Well, if we contrast that with the Cook Islands statute, which says statutorily the Cook Islands Trust Company is forbidden from recognizing any other court orders or judicial proceedings from any other jurisdiction except the Cook Islands. In the U.S., Nevada cannot disregard a judicial proceeding, a court order, or a judgment from California or Texas or Wyoming. None of the states can from any of the other states. So we have an instant conflict of law issue right away. Now add to that we have all sorts of conflicts of law and cases already on the books which show that California doesn't give a hoot if you have a Nevada asset protection trust, because California doesn't recognize the concept of a domestic self-settled spendthrift trust. They don't care that Nevada has one. And if you're a California resident or even just in a California court, you can be really, really sure that California doesn't care and is not going to respect your Nevada trust. How does that affect the Nevada trust? Well, it does. And what we've seen is that trustees and trust companies have been very sketchy, and they are not willing to stand up to a judge or a judgment or a court the way a Cook Islands trustee would, because they do have jurisdiction, they do have repercussions. Not to mention that even between domestic asset protection trust states, we've had conflict of law issues where we have a case where it's between Utah and Nevada. Both of them have DAPT statutes. And yet the family court in Utah just said, well, I don't care. This doesn't make any sense to me. I'm disregarding the whole thing. So you really have to say that a domestic asset protection trust is fundamentally flawed. Add to that federal and bankruptcy law issues, which really override the state statutes. So if you're in a bankruptcy court, like a case we had out of Washington where the guy had an Alaska trust, well, the Alaska Trust Company rolled over in about 5 seconds and wrote the check because it's a bankruptcy court, and then of course federal courts. So bottom line is that there's tons of statutory exceptions. Every state's DAPT statute has exceptions. This makes sense because they need to make an attempt to make their statute reasonable and viable. And so in order to do that, they say, okay, well, let's make a bunch of exceptions so that we can try to make this work. Not to mention that all of those statutes are really designed for residents of the state. So, if you have a California client and you're trying to use a Nevada trust, you already have a problem. So for all these reasons, the cons are effectiveness. It's just, I personally will not use or draft a purely domestic asset protection trust. I just don't have enough confidence in any of the jurisdictions. And it's not the jurisdiction's fault. It's the fact that they're inside of a larger animal that they just cannot do anything about, which is the United States. So I personally don't feel comfortable doing a domestic asset protection trust only. I'm not saying they're of no value. I think if you live in the state and you really strictly meet the guidelines and you really don't feel like you have a better option, that doing a domestic asset protection trust is certainly better than doing nothing. But I do not think it's the best option. And I think what I've seen is attorneys are agreeing with me more and more. I talk to attorneys all day long. In my practice, I work with attorneys all day long in co-counseling with them on cases. And I can tell you that they feel the same way. They're not comfortable. They're like, yeah, I'm not comfortable. There's been too many failures. I predict that there will be more high-profile failures of domestic asset protection trusts, and it will just continue to diminish their value and limit and circumscribe the appropriate times in which they can be effective or even useful. So that's the big thing. Also, if you are going to attempt to use a domestic asset protection trust, you have to be far more strict on the control element than you do in any other circumstance I can think of. Because if you try to leave the client with any kind of control in a domestic asset protection trust, it will be the kiss of death when a judge is tearing that trust apart or opposing counsel is tearing that trust apart, and they're pointing to all the ways in which the client retained control. So if you're going to do it, you have to do it in a very strict drafting fashion, and I mean very strict, and that's problematic for clients. They don't like that. They want to keep control. So it's just one more reason why I don't like domestic-only asset protection trusts. So I looked at this world, and when I looked at it, there weren't even domestic asset protection trusts, but I relook at it every single year, and I always ask the question, is there a way that I can get the best of both? Can I have a trust that is as simple or simpler to maintain than a domestic asset protection trust, but gives me the protection of a foreign trust? And the answer is yes, and it's called the bridge trust. What the bridge trust is an offshore foreign asset protection trust registered in a foreign jurisdiction that has a foreign trustee in a standby role. And then for the purposes of 7701A30E, which is the code section which defines whether a trust is foreign or domestic, we make that trust domestic. In other words, we meet the two-part test, which is, does it have a U.S. jurisdiction that has primary supervision and control over the trust? And does it have a U.S. person that has primary control over the trust, which means the trustee? So the answer is yes. We assign a U.S. jurisdiction. It can be the jurisdiction the client lives in, or it can be one of the asset protection jurisdictions, and we take that on a case-by-case basis. Depends on the client. And the best thing for the clients is we make the client the initial trustee, which meets the two-part test and gives the client what they really, really want, which is control of their assets. How do we do this? Well, we do it by bridging that trust to the Cook Islands, to where we have the strongest jurisdiction in the world on standby. But initially, it is a tax-neutral domestic grantor trust. Can you think of another tax-neutral domestic grantor trust that clients are familiar with, that you're familiar with, that you know exactly how to use, that you're very comfortable with? Yes, it's called a revocable living trust. This is as simple to use as a revocable living trust because it's effectively an irrevocable but tax-neutral domestic grantor trust. There's no IRS Form 3520 or 3520A because it's not a foreign trust. There's no FinCEN, FACTA, FBAR, none of the foreign requirements because there are no foreign components. There's no foreign bank account. Clients can keep their money at their own bank or their current financial advisor, which, by the way, is a huge benefit because the last thing I want to do is get into a contest with a client's financial advisor over our planning. I want them to keep their financial advisor. They're happy with them. They've been working with them for a long time. I'm not going to come in and say, hey, well, you got to do our plan. And by the way, you have to have a new financial advisor that can work offshore. That's not good business and it's not good for clients. There's no IRS filing requirements at all. It's a domestic grantor trust, just like a revocable living trust. And until that changes, there's not even a 1041 trust tax return. It's really straightforward. Assets can remain in the U.S. with their current bank, their current brokerage, their current financial advisor. There's no initial active foreign trustee. There is a standby foreign trustee, but he's not, that company is not in any active role, and so costs are also lower because of that. Because we're paying them, but we're paying them to be on standby, not paying them to be in a full trustee role. And the client can begin as the initial trustee. Let me tell you, this is maybe the most important feature of the trust because clients want that. If we have to trigger the trust, it is done by a declaration of the protector that there has been an event of duress that causes the special successor trustee, which is the offshore trust company, to become the full trustee. Then their initial act is going to be two things: to remove the client as trustee and to drop the U.S. jurisdiction and move the trust fully to the foreign jurisdiction. So at that point, it becomes a fully foreign asset protection trust with no U.S. trustee and no U.S. jurisdiction. So we have all the protection of an offshore trust at the time at which becomes necessary, when it becomes obvious that that is what needs to get done. In other words, when there is an event of duress. In other words, when the client gets sued or threatened to be sued or has something else in which they are just uncomfortable with those assets sitting here inside of a domestic trust. And this combination really has been the winning combination. It is an extremely effective tool. It is very easy for the clients to understand this trust. They get it. And they get what they want, which is when they hear about the foreign trust, yeah, that's what I want. And when they hear about the compliance and the cost, no, that's not what I want. They hear about the domestic trust, they know they don't want it. In fact, most clients walk in the door going, yeah, I've already researched it on my own and I don't want a domestic asset protection trust. The bridge trust is the solution because it gives them the simplicity that they want, the simplicity of maintenance and setup, but it gives them the offshore protection in the event they need it. And that is our fastball. We developed this trust. We've been doing it for 20 years. I've started to see other companies that are starting to copy our strategy. They're using a similar type of trust. They call it all sorts of different things, but we really did pioneer this concept. We've been doing it for a long time, and we've done thousands of these. I can tell you it is just a great tool for clients. They get it and they like it. And it's a great tool for us as attorneys because we get to give them what they want, but we give it to them in a way that is so simple. So the bridge trust, let's test it to our 4-part test. Is it effective? Absolutely, because the time at which it's being used, it's a fully foreign Cook Islands trust. There is nothing more effective. Control, yes, the client can have all that initial control. The only time they lose that control is if they really need to use the trust. And believe me, at that point, the clients are quite willing to be to lose the control of the trust. Cost, it is reasonable. It's kind of right down the middle of the costs to set this up. Compliance, there's none, and then there's full offshore compliance, but there's none initially, and that is the key. The whole point of the offshore trust is if a client really needs to use it, trust me, I have thousands of points of reference. If they need to use it, they will completely get over the control element, the compliance element, and the cost element. They will. They just care about the effectiveness at that point. Prior to them really needing to use it, then they really care about the control, they really care about the cost, and they really care about the compliance. So that's the way we do asset protection. I'm going to put this all together visually for you just because a lot of us are visual and I like to see it this way. So here's the Asset Management Limited Partnership. This is the holding company. Those little houses are LLCs, and they're going to hold the rental property, the boat, the airplane, the businesses, anything that could be considered risky. And then there's the bridge trust, and we still use a separate revocable living trust. And I'll explain why that is. But it's still very effective, and it's easier. And again, I like things easy. Okay, so the LLCs go into the Asset Management Limited Partnership. If they're single member, that's even better. They don't have a tax return. All the accounting gets done on the Asset Management Limited Partnership return. What else goes in there? Cash, stocks, bonds, coin collections, Bitcoin, Ethereum, cryptocurrencies, private company investments, private equity, anything you can think of that is a securitized type asset. Who controls the Asset Management Limited Partnership? The client. They're going to be the general partner, either directly or via an LLC, most likely a Wyoming LLC for privacy. And then who owns the Asset Management Limited Partnership? The Bridge Trust as the majority limited partner. Let's say 98%. So what happens? The client goes on and at some point they die. The assets are going to pass through the revocable living trust. All the assets, the Bridge Trust assets pass down through the revocable living trust as well. That distributes the asset, maximizes the estate tax exemptions, avoids probate, and smoothly pass the assets. That's option A, and that's what we hope happens. Option B, we have a threat. In that case, the assets are going to be triggered. The Bridge Trust is going to make a call upon the limited partnership to distribute all its assets upon that predefined event, and then it's going to take those assets offshore. And at that point, we have a fully funded foreign asset protection trust, most effective trust in the world. So that's the way we do it. We found it very effective. We've become very good at telling this story of how we do it, both to attorneys, to CPAs, but most importantly to clients. Our clients do understand how our planning works, how their planning works. And if you're considering adding asset protection, which I highly encourage you to do because it's a great field of law, I would really encourage you to become a member of the Asset Protection Council. There's no cost to this. You simply sign up. You and I will have a conversation. I'll explain to you how this works. We have a very robust support system for giving you the resources, and we have a lot of resources. We have digital resources from the logo that you see on the screen that you're allowed and licensed to put up on your webpage as a member of the Asset Protection Council, to a whole library of videos that are branded Asset Protection Council that you can host on your page that will explain asset protection to your visitors, to your clients. We can help you design a marketing campaign to your existing clients, help you to communicate that. I do joint webinars with my affiliate attorneys all the time, and that's very effective in creating the story and helping the clients understand that you are in the business of asset protection. Many of my affiliate attorneys are already doing asset protection and have been for many, many years, but they stopped when it came to the trust. They just never got comfortable with the offshore trust. I actually had quite a lot of attorneys that said, yeah, I did one way back in the beginning with Barry Engel, or one of the original creators of the foreign trust. And I just did one or two, and it was complicated and it was hard, and the client, it didn't fit. It wasn't an easy solution. And then I just never did it again. Many of them also just said, I looked at the domestic, I kind of waited to see what was going to happen. I even did 2 or 3 of them, and then I realized I wasn't comfortable anymore with the domestic asset protection trust. So I've limited my practice to really the limited partnerships and LLCs and business structures. And when they see the bridge trust, they realize now here's a solution that they can comfortably integrate into their existing planning. And it's proven to be just very effective. And again, we're very hands-on. I'll come and speak to your clients, most likely digitally through a webinar, and work directly. When you do get a client or a prospect that is interested in becoming a client, we'll do a joint analysis. So we do the analysis together. I'll take the ball. I'll do the full analysis. You'll see exactly how it's done. And it's very effective. Our ratio of converting analysis coming from affiliate attorneys to clients is about 50%. So about half of the analysis that we have with leads that come from affiliate attorneys become clients of both firms. That's very, very high. And I can encourage you to find your way into our system, because it's just a great way for you to add asset protection. So that's what I have for today. If you have any questions, now's the time. I don't see any yet. I'd encourage you to go to assetprotectioncouncil.com. You can download the application there. You can certainly just call us directly. And the phone number is 602-230-2014. Ask Coletta to schedule an appointment with me, Doug Lodmell, and we'll have a conversation. Shoot me an email, doug@lodmell.com, and I'm happy to answer any questions directly if you have any. And that's it. Look at asset protection as a way to add bottom line dollars to your revenue by adding a new area that is simply one of the best that is out there for getting new clients. Okay, here's our first question. So what are your fees for becoming co-counsel? There's no fees to become a member of the Asset Protection Council and hence capable or qualified to co-counsel with us. The way that our fees work as co-counsel is that 25% of the legal fee is paid to you, and then we do the lion's share of the work. We do all the heavy lifting. Which means that we draft the trust, we register the trust, we walk the client through everything. After 5 clients together, we consider you experienced, and we move the fee up if you want to take on more. So there's a capacity to move that 25% to 40%. And that's just a function of whether you're really going to make this a big part of your business or whether you're just going to do 1 or 2 a year. But I'm totally open to coaching into making this a big part of your business, and I hope you want to make it a big part of your business. Okay, next question is, what does it cost to set up the Bridge Trust? Great question. So the Bridge Trust itself is $23,000. And then there's an annual fee of $2,100. So that's the setup cost. The Bridge Trust is almost always used in conjunction with that Arizona Asset Management Limited Partnership, and that's $6,000. So the normal setup cost for a full structure is $29,000. I offer clients 2 ways in which to pay. They can pay a 50% retainer, and then they can pay 50% when the documents are delivered. And I let them know that that's all going to happen within 30 days. We are a very efficient firm. We do not mess around. We do not sit on files. We get documents out because there's no reason to sit on a file. Nobody wins by doing that. So we get documents out within 2 weeks normally. Clients are having them back within a month. So the other option is if you choose to pay up front, there's a 10% discount, which brings the fee down from 29,000 to 26,100. I will tell you that 9 out of 10 clients choose to pay up front. I prefer this. It's worth it for me to take 10% off because I don't like collecting from clients. I much prefer to have it up front. So that's it. And again, most of them take it. Okay, great question. Next question. What are the fees for the foreign trustee when they're not acting as trustee before triggering? That is in the $2,100. So in the $2,100, that covers the offshore trustee in the standby mode, the re-registration of the trust each year. It also covers the protector, and it covers the statutory agent in Arizona, which is going to be us. It also covers our firm. We do not bill clients by the hour after we engage them. It's just that annual fee. So we spend all the time we need with clients throughout the year, and we don't bill for that. If you're not already doing that, some type of annual fee with clients, I would strongly encourage an annual fee. It is an extremely effective way to get clients to be on your page all the time. And that's important. You want clients on your page. You want them calling you and not avoiding calling you because they don't want to get billed for 15 minutes of time. This also includes all my communication with other attorneys that are related to our clients, with CPAs, investment advisors, anybody on their team, them or on their team. I'm not going to bill by the hour. I never have any pushback on that $2,100 fee. When I explain it, they're always quite happy. So great questions. There's a bunch rolling in. Okay, you said 25%, 40%, or up to, and then a question mark. The answer is it's 25 or it's 40. That's it. 40 is the max. And again, we still do all the heavy lifting. So we're still going to do all the drafting, registration, all the work. It's just that we feel like once you have done 5 cases together, you're actually taking on more of the work in the initial consulting with the client and the selling part of it. But we're still going to do all the heavy lifting on the drafting and the work. Okay, next question. How does the revocable trust work within the structure? Oh, I'm glad you asked that because that is important. The reason we continue to recommend and have a revocable trust, even though we have a bridge trust in place, is because, one, most clients have a revocable living trust in place. And so we don't really want to redo all that work and try to integrate all those terms into the bridge trust. 2, the bridge trust is irrevocable, and it really makes sense for it to be as static a tool as possible. We really don't want to be, even though we could have distributions that are amendable inside of the bridge trust directly, it's just a lot easier to point the bridge trust down to the revocable living trust. So how it integrates is the bridge trust is told to look at the revocable living trust at death and make a distribution at death per the terms of the revocable living trust. That way, the revocable living trust continues to be maintained and updated by the same attorney that did it originally. The client doesn't have to change it or redo it. Also, the bridge trust is told that, if at death there is some type of liability or potential risk to the estate, and it's unsafe to distribute assets directly to the revocable living trust, that the bridge trust is told to simply adopt all of the distribution provisions of the revocable living trust. So in a real risk scenario, the bridge trust just adopts the entire revocable living trust terms, and then it will distribute directly per those terms, but it'll do it in a safe way. In other words, it won't expose the estate. So sometimes I'll say, if the husband and wife both die in a car accident where they were drunk on the way home and they kill a van load full of brain surgeons on the way back from a convention, leaving a $40 million potential liability to the estate, then the bridge trust is just not going to distribute to the estate and hence expose the assets to the risk. It'll just adopt the provisions of the revocable trust and then save the assets for the kids. I've never had that happen, but it certainly makes sense if you're going to set up an asset protection structure to make sure it protects under all circumstances. Okay, next question. These are great questions, by the way. If the bridge trust is irrevocable, is there a loss of the step-up in basis? That's a great question. There is not a loss of the step-up in basis because even though it's irrevocable, it is a grantor trust. So it still qualifies for the step-up in basis. A lot of attorneys are confused by this because in the vernacular and in the kind of the traditional way in which we all learn how to use an irrevocable trust, it is a completed gift. That's kind of become the definition of an irrevocable trust for most of us. But that is not the definition of an irrevocable trust. The definition of an irrevocable trust is that it's not revocable. It doesn't say anything about whether it's a completed gift or an incomplete gift. So in the case of the bridge trust, it is a grantor trust. Assets are still includable in the parent's estate, and the step-up in basis still applies at death. The trust is just simply not revocable. However, it is amendable with the consent of the protector, and it's very flexible. The assets can also be distributed as long as there's no event of duress. So it's a very flexible trust, but it is, from an asset protection standpoint, it needs to be irrevocable. Otherwise, we have a problem with the court, who is going to look at a revocable asset protection trust and say, well, it's revocable, revoke it. So, and I've got a great tax memo on that I'm happy to send you, that explains that, because it is a concept that most attorneys are a little bit like, wow, okay, never really thought about it. But once you look at it, it actually makes a lot of sense. It's still a grantor trust. But what a great question, Jim. Thanks for asking that. Okay, so for estates, next question. For estates of 1 to 2 million, holding real estate as a major portion of the estate, 60%, would you anticipate the need for the full bridge trust? That is a fantastic question, because that is the majority of our clients are exactly what you just described. A $1 to $2 million estate with 60% of that 1 to 2 million sitting in some form of real estate. The answer is yes, absolutely. We want the full bridge trust. Here's why. The bridge trust can still protect real estate. Just because the real estate itself cannot be physically moved offshore does not mean that the trust still can't be an umbrella of protection around the real estate. So, two kinds of real estate. There's either primary residence real estate, which most of those 1 to 2 million clients have, and that's usually what is 60% of the estate. If it's primary residence real estate, that real estate is going to go directly into the bridge trust. Why? Because the bridge trust is a grantor trust. As a grantor trust, it maintains the 3 benefits of home ownership, which is tax-free capital gain upon the sale of the home mortgage interest deduction, and the homestead exemption, not to mention step up in basis. So we want to maintain all of those, and we do that by having the home in the bridge trust because it's a grantor trust. However, if we ever have a serious risk or threat to the assets, that trust can do one of two things. It can mortgage the home and strip the equity out of the home, sending the equity offshore, or in a real dire emergency, it can sell the home and send the proceeds offshore. But again, it's key that the asset itself is pre-funded into the trust prior to the client having a problem. That's why all of this is all so important to have done prior to problems arising. If I could get every client to call me first and set this up before they call me as an emergency, obviously I'd be happy. Great question. Okay, next question. How does this work with a non-U.S. person as grantor? Wow, great question. We do have quite a few trusts set up with non-U.S. persons as grantors. It's done a little differently, but it's still a very similar concept. We just drop the U.S. component. So if you're talking about a non-U.S. person that is a non-U.S. person completely, meaning no green card, no U.S. connections, or just a pure non-U.S. person, then we do not involve the U.S. in any way. We'll register the trust offshore, and we'll still bridge it to the Cook Islands. So we will register the trust in Belize as the initial jurisdiction, which we do with all of the bridge trusts, and we'll bridge it to the Cook Islands. We can still have that non-U.S. person as the initial trustee. We still draft it in the style as a grantor trust, but we don't involve the U.S., so the U.S. has nothing to do with it. And of course, depending on the country from which that person is from, there's going to be whatever issues there are there. But for most of those clients, they're going to have counsel in that country, and these assets, by and large, are going to be outside of that country and non-considered. That's why they have them out to begin with, because most countries don't taxed like the U.S. taxes. We tax on worldwide income. Most countries do not. They tax on domestic income only. So oftentimes it's just off the balance sheet of that home country, and it's sitting in this neutral third country. But that's a great question. But we can do it. We do it quite often, and it just depends on the country and what the tax considerations are. Okay, next question. So even though it's irrevocable, it's still included in the grantor's estate for estate tax purposes. That's a clarification question. The answer is yes, it is still included in the grantor's estate for estate tax purposes. It's defective grantor trust. In other words, it's not a completed gift. We are not making a completed gift. The grantor has retained enough interest in that. Well, what is the interest the grantor has retained? They're the beneficiary of the trust. So they clearly have retained enough interest. They also have the power of appointment to appoint those assets anywhere they want. So yes. And for the most part, unless we're dealing with very wealthy clients that are over the unified credit estate tax exemption, it's not even an issue. If we do have clients over the estate tax exemption and we want to make it a completed gift, we can. It's possible. But in the normal circumstance, we're talking about just your average asset protection bridge trust case, it's going to be includable in the estate, and they're not ready to give it all away yet. Great question. Okay, next question. What if there are U.S. assets in the trust? Does this make a difference when it comes to the foreign non-U.S. person as the grantor? Yeah, well, it could make a difference. It may not, though. And again, if there's U.S. assets, if they're put into an LLC first, and the LLC is held by the foreign bridge trust, then it would just be the normal considerations around that. It wouldn't change the nature of the trust itself, though, because the trust itself is going to be governed primarily by that citizenship of the grantor. That's the way the U.S. looks at trust. They say, who's the grantor? That's who we care about. And the beneficiaries, of course. So as long as the grantor is a fully non-U.S. person, then we really don't have that issue. The way we'd normally handle that is by using a Nevis LLC as the holding company instead of the Arizona Asset Management Limited Partnership. So we'd have a Nevis LLC as an offshore holding company. We'd set that to be owned by the bridge trust, which is at this point a fully offshore trust. There's no domestic component because we're talking about a non-U.S. person. And then that Nevis LLC can own interests in domestic LLCs which hold U.S. assets. So in that case, it's just like any other foreign entity or foreign person holding U.S. assets. These have been really fantastic questions. Thank you all for participating and asking such good questions. I don't have any more. So if anybody's got any last minute questions, please shoot them in right now. Otherwise, I want to thank you, and I really want to invite you to call me and set up a call. We can spend 20 or 30 minutes on the phone. I definitely want you to understand the full context of how we can support you to add asset protection to your practice. I want to make sure you do understand how the trust works in detail, so I'm happy to discuss any of that with you directly. And I encourage you to go to assetprotectioncouncil.com, and I really encourage you to watch the Key Concepts of Asset Protection video series. It's at assetprotectioncouncil.com under resources, and it says Key Concepts of Asset Protection. This is probably the best thing we have done. It is incredibly effective for creating a very, very clear picture in the client's minds of how the bridge trust works. And it is available to you as an Asset Protection Council member to host on your website. So I would encourage you to go and watch that series. It's 15 videos. They're all about 3 minutes long, so it's very easy to watch, but they go one to the other, and they break up the concepts in very bite-sized chunks. We talk about irrevocability, how to use a trust, spendthrift provisions, jurisdiction, all of the individual concepts that together build into the full concept of an asset protection trust, and in particular, a bridge trust. So I encourage you to do that. I did get one last question here, which is, what is the best number to reach you at? Call the main office, which is 602-230-2014. and ask for Coletta. She is my assistant, and she will schedule a call with me. You can also go to assetprotectioncouncil.com, and there's a phone number there. That phone number will also reach us. And definitely schedule a call with me. We'll talk over the details. I hope this has been really helpful for everyone on the call. If you forgot a question and you didn't ask it and you realize it when we get off, again, don't hesitate to email me. Doug@lodmail.com is my direct email address. I look forward to working with each of you. I hope you have a great weekend and a great 2018, and we'll talk to you soon. Remember, it's your money. Act like it.